Welcome back to the Deep Dive. Today we're digging into the latest investor update from the Brigade Hotel Ventures Ltd, or BHVL. They're the hotel arm of the big Brigade Group.
Yeah.
Yeah, our mission today is really to see how this major South Indian player, fresh off an IPO, is doing, and more importantly, how they plan to fund this massive expansion they've announced.
Then those Q2 numbers, well, they definitely catch the eye. You see total revenue up, what, 20% year on year? Solid. But the real headline grabber is the profit after tax, the PAT. It shot up 58%. That's huge.
58%, okay.
Yeah, and it's not just, a booming travel market. It looks like a really smart use of capital meeting good operational results. We should probably unpack that.
Definitely. So the big question seems to be, they just got a load of cash from the IPO, used a lot to pay down debt, right?
Right.
So how can they immediately turn around and plan to spend, what was it, 3,600 crores on expansion, especially luxury hotels?
Exactly. That's the core tension.
Okay, let's map this out. We'll hit the Q2 financials first, the debt situation, then look at how the hotels are actually running day-to-day, then tackle that huge expansion plan and funding, and link it all back to their strategy. So, the numbers. Quarter ending September 30th, 2025, Q2 FY26. Total income came in at 130 crores. That's up 20% from last year.
Pretty strong top-line growth.
Yeah. And EBITDA, the operational profit, was 41 crores. That's up 9%.
Okay, 9%. Slower than revenue growth, but still positive.
But then that PAT figure, 11 crores,
Uh-huh.
and that's the 58% jump compared to 7 crores last year.
Right, and tracing where that P8 jump comes from is key. The presentation makes it pretty clear. Yes, operations were good, but the main driver, lower finance costs.
Connects directly back to the IPO proceeds.
Exactly. They listed, end of July 2025, raised 886 crores in total, including the pre-IPO bit,
Right.
and they immediately threw a huge chunk of that 468 crores at repaying debt.
Wow, nearly half.
Yeah. And that wasn't just, tidying up. It fundamentally changed their profit outlook. Look at the first half of the year, H1 FY26. Their PAT hit 18 crores.
Yeah.
Compared to H1 last year. That's an 18 times increase. 18.
18 times PTA growth. Well, that's mostly financial engineering then, not purely operational, right? They bought down their interest payments.
Precisely. It's a capital structure story more than anything, but a really important one. It cleans the slate.
Okay, how so?
Well, by slashing those ongoing finance costs, they've basically given themselves more breathing room. It makes that huge year-hold 3,600 crore CapEx plan seem, much more achievable. Any new debt they take on now sits on a much healthier foundation.
Right, lower leverage to start with.
Okay.
But before we get off the financials, there was that footnote, wasn't there, about property tax?
Yes, good point. There's some ongoing litigation. Looks like a settlement might be in the works, but they had to account for an extra expense, about 6 crores in Q2 and H1.
Okay, so that impacted the reported profit.
It specifically hit the EBITDA. So the reported EBITDA growth was 9%, like you said.
Yeah.
But if you mentally add back that euro a 6 crore provision, which management seems confident about resolving favorably,
And then the underlying operational growth would have been?
around 25%, much healthier.
25% versus 9. Okay, that's a big difference in perception for investors. Tells a different story about core business strength.
Absolutely. You need to look past that headline 9% to see the real efficiency and, frankly, the pricing power they seem to have, especially in their main markets.
Okay, that pricing power leads us nicely into the operations. The KPIs, what are we seeing there? Average room rate, ARR, grew 14% year over year, hit 7,106 in Q2.
14% ARR growth is strong in this climate.
And RevPR, revenue per available room, that was up 13% to 5,374.
So occupancy must have held pretty steady.
Yeah, very healthy. 75.6% occupancy in Q2.
Okay, solid numbers across the board, but where's the strength concentrated? Is it everywhere or?
Good question. The presentation breaks it down. Bengaluru is a clear powerhouse for them.
Makes sense, given their history there.
ARR in Bengaluru jumped 19% year on year, 19%, to 8,738.
Wow.
And RevPR there grew 14% to 6,807. They are really milking that strong IT demand and maybe limited new supply there.
That's serious pricing power. But what about outside Bengaluru? Can they sustain that elsewhere?
Well, the other geographies also showed strong RevPR growth, actually 15%, so slightly better growth rate.
Okay.
But the absolute ARR number was lower.
Yeah.
So the challenge is, can the new hotels, especially the luxury ones they're planning, match or beat that Bengaluru performance over time?
That's the $1 billion or maybe the 3,600 crore question, right?
Yeah. Let's not forget food and beverage, F&B. That grew too, 14%, reaching 42 crores in the quarter.
Yeah, F&B is important. It's not just room service. Think banquets, restaurants.
How does that fit into the bigger picture? Is strong F&B just nice to have or critical?
Oh, it's pretty critical, especially in India. Often F&B in upscale and luxury hotels can have more stable, sometimes higher margins than the rooms themselves.
Really? Okay.
Yeah, it provides a buffer. If there's a dip in corporate travel, or maybe new hotels open nearby impacting room rates temporarily, strong F&B can help smooth out the overall profitability. It helps explain how they absorb things like that extra tax charge without profits collapsing.
Right, gives them resilience. Okay, so finance is cleaned up, operations humming, especially in Bangalore, supported by F&B. Now, the future, the big expansion. They have 9 hotels, just over 1,600 keys now.
Yep.
The plan, double it. 18 hotels, around 3,300 keys by FY30.
It's ambitious, is putting it mildly, and that requires the big number. 3,600 crores in planned investment by FY30.
3,600 crores. After just paying down debt with IPO money, how are they funding this? Does the presentation give specifics? Is it all future profit and more debt?
It seems to be a mix. That balance sheet cleanup we talked about, that's step one. It maximizes how much cash they keep from current operations.
Internal accruals.
Right. And it makes them much more attractive borrowers for the rest. They'll likely get better terms on new debt now.
And the Brigade parent company must help there too.
And oh, absolutely. Having Brigade Enterprise behind them is huge. It gives lenders confidence, helps secure land, probably lowers borrowing costs compared to a standalone hotel company.
Yep.
It de-risks the financing significantly.
Okay, so the funding seems plausible, if ambitious. Let's look at what they're building.
Oh.
Because it's not just more of the same, is it?
No, definitely not. There's a very clear shift happening. Right now, their portfolio is mostly, upper mid-scale, upscale.
Yeah.
But the pipeline, the new 1,700 keys, it's heavily skewed towards luxury and upper upscale.
How much of a shift are we talking?
Well, currently luxury is a small piece. By FY30, they want luxury to be 15% of their entire portfolio. That's a deliberate move upmarket.
Why? Better margins, presumably?
That's the goal.
Yeah.
Higher average room rates, better overall EBITDA margins. It's a strategy to significantly boost profitability per room.
And they're bringing in big international brands to do this.
Yep. The pipeline includes some heavy hitters. Grand Hyatt in Chennai on the ECR, that's luxury, planned for FY28. Intercontinental in Hyderabad at Brigade Gateway, another luxury flag, FY29. Taps into that business hub.
Right.
And this one's interesting, a Ritz-Carlton on Vaikom Island in Kerala. That's a luxury beach resort, also FY29.
A Ritz-Carlton resort. Okay. They're serious about this high-end push, covering both business and leisure markets.
Exactly, targeting the IT hubs, the airports, but also places people want to escape to, especially those drivable locations from major cities, capturing that high-end domestic tourism trend too.
Which brings us, I guess, to the final piece, making it all work. Operational excellence. Sometimes this stuff sounds like fluff in presentations, ESG, guest scores.
Yeah, but here I think it's actually central to pulling off the luxury strategy. You can't just build a fancy building.
How so? I mean, the numbers look good. Net promoter score at 80%. That's high guest satisfaction.
It is. And things like hitting 59% renewable energy use.
Up from 54% the year before.
Right. Or targeting 20% savings on energy and water in new builds. Why does that matter beyond just being green?
Okay, why?
Because of the partners. When you sign up with Ritz-Carlton or Hyatt or Intercontinental for their top brands, they have incredibly strict operational standards. And increasingly, robust ESG performance is non-negotiable.
So it's table stakes for playing in the luxury league. You have to hit these targets to even get the flag.
Pretty much. It's a prerequisite. Things like EV chargers at almost all hotels, focusing on green buildings, it demonstrates they can operate at the level these global brands demand. It's not just CSR, it's a business enabler for their strategy.
So the operational stuff isn't separate from the expansion. It's actually required for the type of expansion they want.
Precisely. And again, the Brigade parentage helps here too. They have experience building high-quality projects, often integrated into their own mixed-use developments. It all ties together. The clean balance sheet, the operational focus, the parent company backing, it all supports this big luxury push.
Okay, let's try and summarize this for everyone listening. BHVL seems to be firing on, well, most cylinders. They're riding strong demand in South India, turning that into good RevPR growth, especially in Bangalore.
Yeah.
They very smartly use their IPO cash to slash debt, which dramatically boosted their reported profit and, crucially, gave them the financial firepower for the next phase.
Right. Sets the stage.
And that next phase is a huge, deliberate pivot. Doubling their size, but focusing heavily on high-margin luxury and upper upscale hotels, bringing in top global brands.
It's a clear, coherent strategy. Transform the balance sheet, then transform the portfolio mix upwards.
Okay, so here's something to think about. They plan to open 1,700 new keys by FY30, with the first batch coming online as early as FY27.
Yeah, just a couple years away, really.
Given how much they're investing specifically in these high-end brand name hotels, how quickly do you think we'll see that shift impact their overall numbers? Like, how fast will this luxury focus start pushing up their average room rates and their EBITDA margins across the whole company over, say, the next 3 years?
That's the key question, isn't it? The speed of that transition and whether those new luxury assets perform as expected, that's going to determine their valuation story going forward. It's definitely the main thing to watch.